Welcome to the webinar, Why Multifamily Investors Are Expanding into Single-Family Rentals. We'll be talking today about what to expect from this rapidly growing housing sector, which already comprises more than a third of U.S. rental properties, and the opportunities it offers for multifamily investors. I'm Suzanne Silverman, Editorial Director of Multi-Housing News, and I'm here with today's moderator, Sam Chandan, Silverstein Chair at the NYU SPS Schack Institute of Real Estate and founder of Chandan Economics. Sam will be talking with Charles Ostroth, Senior Vice President and Chief Underwriter Credit Officer for Single Family Rental with Arbor Realty Trust, Greg Round, Founder and CEO of OwnAmerica, and Paul Fiorilla, Associate Director of Research with Yardi Matrix. With a panel like this, you're sure to leave this webinar with a lot of new insights and ideas. We're going to leave some time at the end to answer your questions, so please feel free to submit them at any time during the webinar, and we may answer a few along the way. Sam, I'll hand the microphone over to you so you can start the conversation.
Thanks very much, Suzanne, and thanks to everyone on the line for joining us for this conversation about single-family rentals. To kick us off, I'm actually going to ask Charles to tell us a little bit about Arbor.
Sure, Sam. Good afternoon, everybody. Arbor is a publicly traded on the New York Stock Exchange. Arbor is an experienced multifamily lender with Freddie, Fannie, FHA licenses. Arbor does bridge, mezz, and preferred equity financing. We also do single-family rental, seniors housing, and healthcare. Again, we are one of the top agency lenders in small loan space, as well as being an innovator as it relates to technology and underwriting.
And we have four parts in today's discussion. Charles will take the lead on the fourth part, which really does address the question of if you're an investor thinking about entering the single-family rental space, how is it that you can go about obtaining that financing? Greg, tell us a little bit about OwnAmerica.
Sure. Thanks for having me. OwnAmerica is a 10-year-old private company. We launched this business on the heels of the housing crisis because we believed there would be an investment boom in single-family real estate. We discovered along the way that vacant homes are marketed on the MLS and through realtors and through Zillow and everything else, but occupied rental homes had no marketplace. They didn't fit into, they were kind of off the grid. So we built an online marketplace exclusively dedicated to single-family homes that were already rentals, that were already performing and stabilized as rentals. And so we represent institutional investors, and every day the list of professional and entrepreneurial investors that are coming onto our platform and accumulating rental properties. Most of our transactions are 15 to 20 at a time, meaning they don't buy one property, they buy 15 or 20. So we market portfolios of rental properties. And so I'm happy to be here because I think there's a lot of similarities with the multifamily business.
Great, thanks very much. In terms of the flow of today's conversation, I'm going to take a couple of minutes to talk about the outlook for the macroeconomy. Paul will then tell us a little bit about where we are in terms of the performance of the multifamily rental sector overall. Greg will guide us in a discussion of the single-family rental opportunity, and then Charles will discuss with us how it is that we actually finance those opportunities. We'll close, of course, as Suzanne mentioned, with a Q&A. So the first slide on the macroeconomy describes where we are in terms of just those raw growth numbers. And the first thing that you might notice is that we've actually seen a bit of a slowdown, a meaningful slowdown over the course of the four last expansions. 4.1% on average in the 80s, 3.7% on average in the 90s, so to 2.6%, and then during this cycle, 2.1%. There's a very elaborate discussion, let's say, amongst economists about why it is that we're starting to see, or why it is that we see this pattern of slowing down. I think what's important for us at this particular juncture in the economic expansion is that as compared to even a few months ago, economists' expectations for where we are going to be in 2018 have improved a little bit. And the Wall Street Journal Economic Forecasting Survey is currently pegging us at 3.1% growth in 2018, which again is an improvement over sort of where economists saw us for this year when they were surveyed in April. And I think, again, what's particularly important about this is that we are in an environment where monetary policy is tightening up. The cost of the Fed funds is rising. Interest rates are on the rise. But the outlook for the economy has not deteriorated. And I think sort of the best way for us to interpret this is that although rates are going up, it's not having a material and negative impact on the outlook for the economy over the short to medium term. Of course, economists do see things slowing down a little bit as we reach out to 2020. And in part what that reflects is concerns that folks have about where we are in the business cycle. And so if you take a look at the next slide, market outlook, what you can see is that this is sort of a general assessment on the part of economists, where the longest expansion we've had in post World War II history in the United States has been 120 months, just 10 years. And when we look at the duration of this expansion, we're about 9 months away from that right now. So what's important, again, to keep in mind here, no expansion dies of old age. There's no finite length of time that an expansion is allowed to last. But by historic norms, this is turning into a long one. Now, there are a lot of reasons to believe and a lot of reasons to argue that we might go longer than what we have seen before. I think what's also prudent for both investors and lenders in the market is to say, okay, I don't know if it's 6 months or 18 or 24 months from now that we'll experience that inflection. Certainly don't know exactly what the proximate cause will be. But if I'm making an investment or taking an exposure today that I'm going to hold for 5 or 7 or 10 years, I'm going to have that exposure for at least some period of time, during my investment time horizon. I can reasonably expect that there'll be a period of weakness in the economy. So how is it that, I manage my asset? Can I stress my asset or my exposure in advance to understand how it will perform during that period of weakness? And so that sort of, defensive calculation, stressing your investment opportunity against the inevitable period of weakness in the economy, we believe sort of the most appropriate way to go about thinking about this, as opposed to trying to, pin down an exact date on which that next inflection will occur. Of course, the other statistic that we look at, and part of the reason why, in spite of, are seeing in the Wall Street Journal forecast sort of slowing rates of growth over the next couple of years, when we talk to consumers, when we talk to small businesses, confidence is at some of the highest levels that we've seen. Now, we take that with a grain of salt. Confidence levels amongst consumers were also very high in 2007. The fact that they are high does not certainly mean that something is about to go wrong. But what we do know is that what really fuels a lot of that optimism is where people feel they are in the labor market, not the abstract numbers about where growth is, but what's my experience of job security, whether my salary is rising, whether my kids graduating from college have been able to get the job that they were looking for. When you look at the labor market slide, what's interesting here is that you actually see that on a rolling basis, net job growth per month in the United States has been slowing down. Now, as any economist will tell you, depending on what story you want to tell about the labor market, there's enough data that you can tell almost any story. You might just look at this data and draw the conclusion, oh my gosh, things are slowing down. That would not be an accurate representation or characterization of what we actually see. The labor market is in fact extremely tight, and what we do see is that on an absolute basis, there are more jobs open and available in the United States today than there have ever been. Part of the reason that we see this slowdown is that the labor market is tight, and for all of those jobs that are available, firms are finding that it's quite hard to find people with the right skills to actually do that work. And so the difficulty that firms are having in actually finding folks where the skills they need are a good match to the skills that are being brought to the table is why we're seeing, a lot of this slowdown in the labor market. And that's substantiated by the initial claims numbers. How many people are losing their jobs involuntarily? Relative to the size of the labor market, these are some of the best numbers that we've ever seen. Now, of course, with the labor market improving, with that tightness there, with inflation numbers getting a little bit higher, wages starting to improve, we can reasonably expect that the Fed is going to take advantage of this opportunity to normalize monetary policy. What this chart on interest rates shows you is that over the last several years, you look at the relatively short end of the yield curve, those rates have been going up. Now, the Fed has been pushing them up. It has that sort of control over the very shortest end of the yield curve, but the further out you go on the yield curve, it's more that the Fed is exerting influence as opposed to control. And again, what you can see here is that while the short end has been going up, we have not seen commensurate increases at the long end of the yield curve. Of course, when you read about in the paper or economists discussing their concerns about the flattening of the yield curve, this is what they're describing. And right now, the difference between a 1-year and at the other extreme, a 30-year, 58 basis points, that's a fairly flat yield curve. And we do know that we have to watch this closely. It's not a causal driver of a downturn, but if it inverts, that's usually been historically that's been a very good indicator for us that not everything is going in the direction that it should. So we'll continue to watch this. For all of us in the commercial real estate space, the question at the end of the day in our being able to execute on our businesses is how does this translate into the actual borrowing costs that we're seeing in the market? And Charles, I actually want to put that question to you. What do we see?
We have seen a rise in rates. I mean, the rise has not been dramatic, though. It's been gradual. You might get a few basis points here, a few basis points there, then it'll level off, and then you might see a slight drop. But what it's done for the borrowers is typically borrowers, they sit on the sidelines until they really feel that, oh my God, something's happening. If they feel they have time, then they're sitting around, they're waiting to enact on things versus the fact of if they see movement, then everybody wants to close. Everyone wants a rate lock. Everyone wants to move forward. And from an institutional standpoint is some of the programs that are out there do allow an index lock or do allow an early rate lock, and you're seeing more people take advantage of that. The other piece is that with competition in the market and lenders, there's been a lot of requests for interest only on the deals.
Right. So, on one side of this, we've got, these relatively modest and manageable increases in the underlying cost of capital and ways in which, we can mitigate some of the risks around that. There are a range of opportunities available for borrowers when they're working with their lender. The other side of this, of course, is the underlying multifamily fundamentals. And for that, Paul, I'm going to turn it over to you. Where are we in the multifamily sector?
Thanks, Sam. It's great to be here today. Well, the multifamily sector, as everybody on this call probably knows, has been very hot for about 7-8 years. And so that leads to the question, are we nearing the end of the cycle? Real estate cycles don't typically last that long. And I don't have a lot of time, I'll tell you right now. Short answer is no, I don't think we're near the end of the cycle as far as multifamily goes. I think we're entering a longer period of sustained performance and good performance and demand. So when you look at the numbers, the rent growth went to a peak level in late 2015, early 2016, and then decelerated pretty sharply through the beginning of this year. And so then we've seen it stabilize. Rent growth has stabilized 2.5–3% roughly, and it's been sort of that level all year, which is a good sign. Shows that the deceleration has stopped and we're kind of at the long-term averages. And big reason for that is because of the occupancy levels, right? So occupancy levels hit all-time highs at the beginning or during last year, and have since come down as well. But also they're still very strong by historical levels and near historical highs compared to past cycles. And if you look at those numbers, the occupancy is stronger as we go down in terms of the quality of properties, which reflects the fact that about 90% of new deliveries are Class A, or what we call lifestyle units. And demand, because of affordability issues, the demand is more toward the renter by necessity, B and C level properties. So, but still, all parts of the scale are doing really well. And if we look at the next slide and talk about transactions, transactions have been very strong. There's investor demand for multifamily has been strong throughout the cycle. It remains very strong. So since about 2015, we've had roughly about $100 billion of sales per year, and this year we're on pace for about the same amount. See the 2018 numbers year to date through September, so we're on pace for almost $100 billion of sales this year. As I said, demand is really strong. The amount of undeployed capital looking to buy all types of real estate is at all-time high levels, according to Preqin, more than $250 billion. And again, multifamily and industrial are the most in-demand property types at the moment. So multifamily prices have continued to rise. So that's another thing you can see. Cap rates are at all-time lows, and even though interest rates have gone up, cap rates also have remained very stable, which is an indication of the very strong demand that continues to be there because it's relative to other asset classes. It's stable returns, and investors are very optimistic about the future of multifamily demand and performance. And so then on the next slide, you can see coming out of the last recession, housing construction fell really to low levels. And as you can see, there's a big gap between the amount of construction of housing and the amount of demand from household formations. So we're hitting a period now where we're trying to make up that shortage of housing. And as you can see, the single-family market hasn't come anywhere near close to the kind of levels that it had pre-recession. Multifamily has rebounded, but there remains a very severe severe shortage of all types of housing built in this country at the moment. And the chart on the right, you can see that the new construction, because of the cost of construction, because of the location of where property is being built, most of the construction is being built and focused on sort of the higher price point, which isn't where the demand from first-time buyers is. So, as you can see that in this slide, we're talking about this is the millennial generation, or the 20 to 34 age cohort. We're expecting that cohort to continue to grow through the middle of the next decade. So, as far as population trends, the population for rental units is going to stay very strong. And, multifamily construction, as I mentioned before, we're at about 300,000 units per year since 2015. Right now, Yardi, our database, we track roughly 600,000 units under construction. So the construction levels will remain pretty high through the end of 2019, maybe after that. Actually, we originally forecast 360,000 units to be delivered this year, but because of the labor shortage, which Sam alluded to before, projects are taking longer to get completed. There's a very severe shortage of skilled labor in the construction area. So, as we know, real estate, the big factor is location. So just talking about national levels doesn't necessarily do that justice. So we did a study that we published over the summer where we looked at supply and demand by the top 30 metros by population, and this is a multifamily supply and demand. And as you can see from this slide, most markets we're expecting over the next couple of years that supply is going to outstrip demand. And it's particularly the case if, it's a little easier to look at on the next slide. It's particularly easy to see, that the markets with the biggest gap between supply and demand are Denver, Seattle, Charlotte, Dallas, and those markets are all very, what we consider to be very good markets to invest in, right? They're fast-growing markets. The South has, got this long-term population growth towards southern markets where it's, more affordable in general and this business-friendly environment. And in places like Denver and Seattle, they have tech-driven employment base. So even though, over the short term, we're expecting demand to be a little more than, to be less than supply, over the long term, these markets are very good. But I think over the next couple of years, some of these markets will have, maybe rent growth will be a little bit weaker. But over the long term, with, the study, we don't have any more, we didn't have time for that. But over the longer term, the supply is much more balanced. So the markets that have good economies, they're going to be okay over the long term.
A couple of quick questions for you about this data, particularly with the secondary tech cities at the risk of oversupply. What kind of geographic differences are we seeing within the city? Is this concentrated oversupply in the urban core where we've seen a lot of the building activity? When we go out to relatively more suburban areas, is the supply in better balance?
Well, I think, yes, in a lot of these markets, the bulk of construction is in the urban core. And I think that's, one of the issues as far as those, right, because demand is a little bit more diffuse. So I think we're going to see a little bit of weakness in sort of the higher end units for the time being. I mean, a lot of the urban core, the millennials can't afford those, units. They're not making the kind of money. You could see that even in some markets like New York and San Francisco where, rents are just too high even for people with good jobs. So, yeah, I think, that's definitely an important consideration when you're looking at, where to invest and, which markets to invest in. Do the submarkets, you really have to drill down to the submarket. That's a very important point.
And I think with Yardi's information and what Paul brought up is that a lot of the product being built, is that a product? Is that lifestyle product? You don't find, because of the cost of entry in certain markets, you don't find people buying building a C product or a B product. So the need is really going to be in that BC corridor or that outdated product that needs a little tender loving care. There's a lot of people are coming in, refinancing, and repositioning that product. The danger always is that are they looking to take a C property and try and make it a B property? Then would cause that downward pressure. Or The reverse of being that if you're building too much A product, all of a sudden they're starting to offer concessions, and the A is the same price as the B, and someone has a choice, where am I going to live? They're going to go to that A product if they can get the same price as the B product. So I think in a lot of these cities where there are, if you want to say people make a lot of money, that's where the oversupply is. But I would say really in that core working class product where we're missing, and there hasn't been a lot of household formation and people moving in with each other, to me, that's still a good investment.
So those are descriptions along the lines of class designation. Another way that we can look at this is to say, well, what about property size? What are you seeing in terms of what's happening with that small balance property? Maybe the one where the loan size is $2 to $5 or $7 or $10 million versus the $30, $40 million property.
What we see in a lot of these markets, that the smaller properties, the up to 50 units, say, or even up to 75 units, they're sort of without the amenities, without having all the bells and whistles, they are more affordable. There is a gap between what is something that we consider an A property and somebody considered a smaller, say, B property in a lot of these markets. And they are still somewhat, I'll say, somewhat affordable, and you find them very full. If you go to a market like Portland, where there's a high cost of entry, anything that they're building, it's going to cost a lot to live there. At the end of the day, in a 50-unit property that's been there for an extended period of time, the owner's taking care of the envelope, you're in a good neighborhood, good luck trying to find a vacancy in those units.
And that small balance with market is obviously one where you are very active in working to facilitate investment in that segment of the marketplace. Paul, one other question for you about the data. Apartment transactions leveling off, declining a little bit. How much of this might be that there's a bit of a gap between buyer and seller expectations on prices? How much of it might be that that small balance transaction, we're continuing to see meaningful improvements, but that the large institutional $200 million deal or the portfolio level deal is where we've seen some of the weakness? Break it down a little bit for us.
Yeah, I think that on the institutional side, there is some concern that some buyers, cap rates are really low. As interest rates go up, kind of the gap, the premium between, the 10-year treasury rate and cap rates is kind of shrinking. And even though there's still strong demand, I think a lot of buyers want a little bit of a concession for the fact that they're expecting rates to go up. I think also, there's also, in some cases, there's a concession for the fact that, we could be near the end of the cycle. So I think some buyers are getting hesitant to pay sort of the top dollar. And on the other side, sellers are looking at, hey, if I sell this, where am I going to redeploy my capital and make even more? Where am I going to put that money and make the same return? It's getting kind of difficult these days. There's just so much competition. So I think those dynamics are kind of leading to a little bit of a slowdown in some cases. And then, in the big cities, you might have, China has kind of dropped out. So there's still a lot of foreign capital out there, but, not China. So I think those are the kind of things that have kind of, produced a little bit of a slowdown off the peaks from where we were a couple of years ago.
And I think even though there is a lot of competition, people looking for value, they're looking at the properties that are longer, so the deals are taking longer to transact. Just as you said, after they go through their due diligence, they might be going back to the seller and looking for that concession. So now the property that we were projecting to close in 90 days might be closing in 120 or 150.
Yeah, perfect. So if we take a look at how all of this relates then to the single family rental market, what we can see is that it's actually a very different marketplace in that it's a very, very large marketplace. Single family rentals are a very meaningful share of the rental market overall in the United States. From an institutional perspective, historically, we've not thought of it as part of that multifamily marketplace. And so while it's a very large market, institutional ownership or penetration into this market, all things considered, is fairly limited. And this is an emerging sector for us. In terms of what the demand side of this looks like, and this is where part of the potential is the opportunity for this market to become more institutional. Part of it is also what we expect to see happening on the demand side for single-family rentals over the course of the next investment period. Green Street Advisors, you can see on this slide, is projecting that by 2020, the nature of renter household growth will fuel demand for 1.5 million new units of SFR. Greg.
And I would, one of the things that I want to point out that makes SFR different, it is true that it's been here since the Pilgrims landed, and yet it wasn't until 2010, 11, 12 that it actually got the institutional microscope trained on it, and there were a lot of people that were doubting it could actually play out the way that it did. But it's not just big, it's actually practically equivalent to the size of multifamily in terms of total dollars. So you see $6 trillion worth of asset value in rental households. 3 of that is single family, and nobody knew it was that big. I remember being in the room when somebody first showed us in our industry of professional SFR, when the slide came up on the panel discussion, that we saw there were, at that time, 15.5 million existing single-family rentals, and everybody's jaw dropped. We just didn't know. And this was the housing industry we should have known. We didn't know because the housing industry is geared towards home ownership. And that's probably one of the most important points that relates to everything we talked about so far, which is, unlike every other commercial asset class, the majority of single-family homes are owned by the user, okay, also known as owner-occupied, all right? And so that drives valuation, that drives demand, that drives most of the market space. And so when you talk about the economy turns, consumer confidence is high right now. That means that households are forming, people are feeling good about their jobs. It usually means that home ownership goes up. Now, if home ownership goes up, it takes inventory off the table. It disadvantages investors because they're competing with eager homeowners who are, willing to overpay for a house, no matter, they don't care about the yield because there is no yield, it's not being rented out. But what's happening with our clients, the institutional level SFR investors, they're beginning to see the dichotomy of every house could be investor owned or user owned, that gives them almost a risk management tool or an opportunistic tool to say, okay, so in Phoenix, for example, the home prices are skyrocketing again. Rental rates have not kept up with home prices. So if you were to buy property in Phoenix today, you can't even get a 4% net yield on that. Okay, the cap rates are too low, nobody's buying. But if I've got 500 houses or 50 houses in Phoenix, I can liquidate that right now, either selling it to another investor, but they're not going to like their cap rates. So I have the option to liquidate that. It's going to be one at a time, so it's going to be a lot of brain damage. But if the market for homeowners is stronger than it is for investors, I can liquidate properties in Phoenix, pull the money out, move it over to, say, Cincinnati, where the yields are almost double that. The home price appreciation is not there. But if you see what I mean, that when no matter which way the market goes, we're starting to realize in this industry that we've got to play, because if it's strong, home ownership cranks, we win on price appreciation. If the economy goes the other direction, maybe price appreciation flattens out or even, heaven forbid, goes down again, but I'm going to win on yield because rental household creation is going to go up and foreclosures are going to go up. Folks are going to move out of those houses they can't afford anymore and rent. And so it's given us a tool. So the combination of it, having that dichotomy, having that fork in the road that they can take whatever they want, plus the fact that they're realizing that all these institutions that have gotten so many headlines are at 2% of the total market. And we'll talk more about it later, but multifamily, it's more than half institution owned. Single family, it's less than 2%. So the whole industry is starting to catch on to the idea that maybe history is repeating itself. And maybe we're going to see a lot of consolidation going on the next 10 years.
I just think to add to what Greg is saying is that historically in certain markets there was that disparity of what it would cost me as an individual to buy or to go somewhere and to rent, and not even a single family home, but an apartment. And California, historically, you couldn't afford to buy a home, but I could go to a place and I can go and rent it. But we're finding now, as Greg pointed out, some of these markets are becoming heated again. I think there was an article today that said that prices in New York City, I know it's New York City, are above the pre-crash now to own. So if that's the truth, then everybody might say, okay, fine, I can't afford to buy, but I need to live in New York City. I'm going to have to go out and find some place to rent.
Right. Now, this is obviously a tremendous amount of really valuable information. For folks on the call that may be wondering, we will be sending around a link to a replay after today's webinar is over. A couple of stylized facts that support what you're describing in terms of what's driving some of this demand. As folks can see on this slide, part of what we see is continued geographic shifts across the country. We've got extraordinary growth in Texas, Florida, along the West Coast, not as much along the Northeast United States. Part of where the driver for this overall is coming from, though, is that while we may tend to think of millennials as being sort of this young person, perhaps in college, just graduated from college, we look across the spectrum. We have millennials in their 30s. And while it is certainly the case that millennials are on average having their kids later, getting married later than would have been the case historically. The oldest millennials are doing the things that previous generations have done. And what we see is that as soon as you have that first kid, all of a sudden your utility function shifts a little bit, the things that matter to you in terms of the things you need access to.
All of a sudden being able to walk home from the bar is not as important.
Exactly. What becomes important is a good quality public school for a lot of people. And that is driving the oldest millennials in large part to move to the suburbs. And now what we also know is that where historically it may have been the case that you were a renter and downtown, but if you were in the suburbs and then owning your home, what we see is that there are a wider range of options that have opened up. And part of it is, behavioral, cultural in the United States, the idea of renting a single family home, both on the investor side, but also on the renter side, is not as unprecedented or unusual or stigmatized as it might have been at some previous point. So we have millennials. Again, sort of not a homogenous group. There's the millennials are a more diverse population than any generation in American history. But when we do see how the oldest millennials are behaving, they may want to access, have the opportunity to be in that home in a relatively more suburban area, but they don't necessarily want to own the home. So we've got some folks that are renting the home by choice, and we've also inevitably got some folks that are renting out of necessity. In some cases because of uncertainty around what their long-term job outlook will be, so they need to maintain that flexibility. In some cases, because they're not able to find themselves in a financial position to actually make the down payment to become the homeowner. Certainly, one of the things that's contributing to that is that we have more student debt outstanding in the United States today than we've ever seen. And that's going to present a challenge. Now, to what extent this is constraining the ability of millennials to become homeowners is actually a very complex question. And when we look at different research on the academic side, there's a lot of nuance to the answer that we can get over here. But suffice it to say that all things being equal, if young Americans are graduating and going out into the workforce and working to transition to homeownership with more debt relative to their incomes than has been the case in the past, it's going to present challenges for them in becoming homeowners, and it might make sense, to be a renter a little bit longer. With that,
it's an interesting point because I find it fascinating. I'm a Generation Xer. Nobody used to ask us what we were going to do next, and nobody seemed to care what we thought. And so we're one of the What I find interesting about millennials is they keep surprising everybody by doing almost the same thing everybody generations ahead of them did, but just a little bit later, like you said. And so what we're seeing, the student debt, I think, is a big issue. And the realization that living in a single-family home, you don't have to own it to live in a single-family home. In fact, a lot of these entry-level neighborhoods are ending up being 20, 30, 40, 50% renter neighborhoods now. And so it isn't stigmatized anymore. And so it's one of these things that what I'm starting to hear from some of my friends in multifamily is that one of the challenges in multifamily is when someone does get married and have a kid, they're gone. They're out of the building, okay? They want the backyard, they want the dog, and they want the swing set. And so it starts to feel like a smart idea that if you want to have your cost of acquisition of that customer, that tenant, go real long-term and see the long-term value of that customer expand, we're starting to talk to some folks who are saying, hey, I have X number of units in Tampa, but I do have attrition every year of people who graduate out of apartments, essentially. That's not my management, not my apartment, not my location, none of those things. It's just their lifestyle has graduated them to now want a home with a backyard and a dog and kids and a swing set. And I think it's going to make sense for a lot of people to say, if I own X number of units, let me take a position in the suburbs so that I can hang on to my customers, move them out of my high-rise or my downtown location into one of the suburban locations, whether the customers want to buy. Millennials don't just live in houses because they want to be homeowners. Millennials sometimes live in houses because they want to have a dog and a kid. And so that in-between step is something the multifamily industry can position themselves for.
What we're also seeing is a lot of what I'll call build-to-rent homes.
Yeah.
So now the properties are not necessarily, or the subdivisions aren't being built with a homeowner in mind. They're being built with, I'm building these 100 units, and they're going to be for renters. And they're setting them up that way just to meet the need of not only new family formation, but what the millennials want. As you said, having the dog, having a child, but also the fact that I don't have a mortgage. Because also we found millennials, they like to be able to move. They like to be able to pick up, job situation changes, or I have another child, or might go back to where my parents are. You never know, but a lot of people are now moving into the space of build to rent.
So that's actually really interesting for me. When we look at what is being built, if I'm building with the expectation that I'm going to sell it and it becomes owner occupied versus if I'm building with the expectation that I'm then going to make it available for rent, how does that actually change? What am I building? Am I doing anything differently across those two scenarios?
We're not seeing much of a difference. If it's entry level, tenants are willing to pay a little more for the granite, same way as a home buyer will.
Okay.
What I found the most interesting is the builders. That's become a big craze in our industry, build to rent. And when I've spoken to builders, they were not rental builders that turned into single family rental builders. They were just home builders. And the tone that I'm catching off of them is that their life is a treadmill. It's like a wheel, okay? So they go in, they buy land, they get the approvals, get the entitlements, they go in, they improve, they build, they sell out, they take a breath, they go back to the next one then. And when the economy turns, when it goes bad for builders because the economy turned and there's somewhere too much in the middle of that cycle. And what they've been saying is if we had kept 25% of the subdivisions we bought and built, I should say, if we kept 25% of what we built, either 25% of the homes in one subdivision or 25% of the subdivisions, their economic picture would be totally different. They'd be cash flowing. They'd have control over the build. They'd be able to lease it. And then over time, some of these home builders, these are medium-sized home builders that have built tens of thousands of homes over 20 years. They could have had a really substantial portfolio by now if they had held on to it. And they're starting to see the wisdom and cash flow in their business rather than the lumpy roller coaster ride they're used to.
Yeah. Because they always have to be working. They always have to be on, as Greg pointed out, to their next project. Within doing this, now I own that. Now I own, and I have rent coming into me. I just have to manage it. I can go on to the next one, and it gives me a little room to decide, do I want to do it for sale? Do I want to do it as a rental property? Or maybe I'm just going to sit to where the market's a little better. But the whole thing is when acquiring the land and having that entitlement, and now I have to move, but now they have a choice. The choice is, am I going to do the build to sell, or am I going to do the build to rent?
Right. So this is very on point. We've got some questions coming in around, what does the single family rental institutional asset look like? And it sounds like if I'm building a large portfolio, the homes that I own don't necessarily look different from, homes as we would think of them in the larger.
3 bedrooms, 2 baths, built since 1980.
Yeah. Okay. So with that,
and for now, again, getting back to just technology amenities, just having the availability of the technology, and maybe a little more bells and whistles as it relates to that, because renters still do want that, even though it's not necessarily something that I'm owning the home. They want those opportunities to have that within the house itself, whether it's speakers throughout.
They don't want Formica.
Exactly.
Renters don't want Formica. They don't either.
Especially in the situation of having a home and having a garage, and depending upon who has to take care of the lawn, place to put my lawnmower.
So perfect point to segue into, Greg, your discussion of the ownership trends and opportunities in the single-family rental space.
Well, the ownership trends, what's very, very interesting is that the players that have kind of think of this whole SFR thing as a very dense jungle that a handful of pioneers hacked their way through back in 2011, 12, 13, and 14. And there were some very smart people in commercial real estate who said it couldn't be done because nobody can manage 25,000 houses nationwide. But I'm happy to say now, looking back, that literally everybody who tried it, everybody who went after that actually accomplished it. So the management, which seemed daunting, because you have 10,000 units, you have 10,000 HVAC systems, 10,000 different roofs. They're scattered about. You have a different scenario. What we've learned, though, is that the balance of it's more complicated to manage, but the tenants stay longer, ends up leading to anybody with any kind of scale is easily getting a 60% NOI, which is pretty consistent with multifamily. The ones that have the best operating systems and the tightest proximity of their portfolio and have scale in certain cities are getting 64, 65, even pushing 70% sometime soon NOI. And so the opportunity, it's very, very similar. And it reminds me, I study multifamily from the 80s and 90s, and it looks so similar to me in that we had deregulation, lax lending standards, turned into bad loans, turned into a big distressed property trend, government bailout, big attraction of capital from Wall Street coming in and seeing an opportunity. They came in for the opportunity. They stayed for the business. They liked what they saw. They built the infrastructure. And then now we're at the point where, like we were back in the 92, 93 in multifamily, where a whole lot of new capital is starting to flow in. Our clients who already have 10,000 houses are showing back up again with a fresh billion to work with from a pension fund, an insurance company, a sovereign wealth fund. So people that have the experience are getting a lot more capital. And I'm a big believer that people with multifamily experience have all the experience they need for single family. It's the same, but it's different. And so where the players that are in it right now are really concentrated in the same 15 or 20 cities, and you know what they are, right? They're the cities that were the hottest ones in 15 years ago. So Atlanta, Charlotte, Dallas, Houston, Nashville, Tampa, Orlando, Jacksonville, those southern cities that are the job migration cities, they were the hot ones. They were the ones that were the big foreclosure cities. They became the ones that were the big initial SFR cities. And a lot of those big investors are almost like stuck there now, because if you don't have 1,000 houses in a city, you can't operate at the NOI you need. And you have your quarterly earnings call coming up in a few weeks, and you can't erode your NOI. So the opportunity is the second round of cities. There's a lot of places out there that are not yet trampled on by institutional investors, where players that are coming in now can achieve scale in those places and be the big dog.
I mean, to me, it's a simple model of having the capital and deploying it. But right now, with, I would say, favorable tax code, that people are looking places to put their money because they're not going to be taxed at the level they were. The other piece of that is migration of people moving out of the Northeast that are in high tax states and then moving to the Texases of the world and the Floridas of the world and not having that state income tax. So there's going to be a need for them, but it's a different mindset as a renter.
Right. Can you tell us a little bit about what's happening with valuations?
The funny thing about valuations, and I think this chart is actually rental increases, but in either case, this goes back to that point I made first about how the dichotomy of the single-family home, the valuation of single-family homes is still driven by comparable sales. Okay, I have not yet sold an SFR to an investor who is willing to pay one nickel more than they could buy a vacant one across the street on the MLS for. And so the cap rate is derived from what the price is based on comparable sale, not the value is based upon what the cap is trying to achieve. If they can't get it for at or below standard market value, they're not going to buy it. So it's growing right now. Okay, the home prices are going to start leveling off. They've gone a little bit too hot for a little bit too long. You're starting to see, you look at the stats today, you're starting to see home sales are declining. Well, home sales declining, because keep in mind, again, investors are still the smaller part of the housing market. So when home sales overall are declining, it's mainly owner occupants that are driving that. And those home sales are declining because the buyers are saying enough already. I can't keep paying these escalating prices. We don't have a bubble. This is how you avoid a bubble. The buyers pull back. So that's where we're at right now. That's going to cause us to see a leveling off of price appreciation. And it'll give us some time for the rents to catch up, I think, and then we'll see the yields begin to decompress a little bit.
Charles? Yeah, two things. One, I'll touch upon what you just talked about as far as, what we looked at before about the multifamily market, about rental increases. Single-family rental market, the rental increases are going up, I would say, at a higher pace. I don't have any data with it in front of me, but that's what we've seen. The other thing about valuation is, it's interesting you bring that up, because, as a buyer, you're saying they're not going to pay a dime more than what they feel, whether, vacancy, cap rate, where it's at. But as a borrower, they're going to try and maximize things, and it's an investment property. The example I always tell everybody is that I, as an investor buying a piece of property or a single-family unit, it's worth X to me. As a buyer and homeowner and occupier with 2 kids, it's going to be worth Y to me. Meaning, as you pointed out before, if I want my kids in that school system, it's going to be worth, and I might pay more versus somebody who's an investor looking for a yield. I might go to another neighborhood where it doesn't have such a good school system. I'm not paying that for that home, but the investor might. What we have found as an opportunity in lending is that we have been using somewhat of a hybrid model, because a lot of these, what I would call broker models or BPOs, what they're doing is they don't stratify the class. So I can have a block of properties, and I can have one that needs renovation, one that the same family's lived in for 30 years, and one that's been renovated is for sale. The prices of those 3 properties are going to be significantly different. When you start taking some of these algorithms, they're not stratifying. They're bulking them all together and then spitting out a price. So something that is unrenovated is going to drag that down, versus the fact of looking what I can get for this property from a rental perspective, or a lot of these algorithms won't. I'm going to come in, I'm going to take this property, I'm going to make it into 2 units. The algorithm's saying that my rent on a single family in this market is $1,500, but now I have 2 units where I'm getting $2,800. So that's one of the things of why we're taking more of a commercial approach to things. And what I talked about being at the forefront, technology, looking at things a little differently. Arbor, we've done it. We have an appraiser that will do it. We have a lending partner that understands that. So we've actually been able to capitalize on our expertise in the multifamily market and valuations.
So we're going to jump ahead in a second to this question of how the financing works. Before we do that, just one last chart that I'm fascinated by, Greg. Single-family rentals increased faster than apartments in 22 of 30 big cities. Can you break this down for us?
Yeah, the only one that makes no sense to me is Boston, because Boston has not, which is number 2 on this chart, because Boston has not even shown up on the institutional SFR map yet. The price is too high, taxes too high, yields aren't there. But every one of these other cities, these are the ones I was saying before, that if in 2004 it was hot as a pistol, that means in 2008 it was a foreclosure capital. That means in 2012 it was an SFR capital. And what you're seeing here is when somebody goes from an apartment to a house, they want to stay in a house. It's kind of it's common sense and it's human nature. And so it's outpaced. It's outpaced. And more and more people are beginning to recognize that the slide before, which you don't have to go back to, people saw that the percentage of SFR that are owned by individual investors is massive. It's the vast majority. And so there's that consolidation opportunity that half of the SFR are owned by somebody who only owns one, okay? And there's 20 companies that own 2%. And so what we think is taking place now, and these cities are going to be part of that, is the large investors come in, they want to see if they can buy 50, 100 at a time. They want to consolidate. I think we're going to see, look, if $2 trillion worth of multifamily was institutionalized after the cycle it went through back in the 80s and 90s, and we're following a very similar path right now, I think we're going to see $500 billion to $1 trillion worth of single family consolidated over the next decade for the exact same reason. The financing is now in place that wasn't before, and the ability, we view this as a food chain where there's a guppy in the front and there's a big shark in the back, and there's a lot of ever larger fish in the middle of this food chain, and a lot of people are in the middle here accumulating their 5th one to sell to the guy who's got 95 and wants to get to 100 because he wants to sell to the gal who's got 500, wants to get to 600 because they want to serve it up to one of the whales.
And also, you have seen families that for years in certain markets have accumulated 1, 2, 3, 4 at a time. Now it's time for them to get out. Right. It's time for them to move on. It's time for them to set up their trust. Right.
How does an institution create a critical mass in markets where there isn't right now, and really need to have it in order to become like a national institutional market?
That's a great question. And the answer is every channel they can come up with. The big institutions that are buying hundreds of thousands and are redeploying now with another fresh billion, they're buying vacant homes on the MLS. They have infrastructure to go out and compete with John and Jane Doe for a vacant home. They're buying on platforms like ours and others that have emerged that package up portfolios or represent sellers of portfolios. They're not going to the auction steps as much anymore because there's nobody there anyway and there's no properties there. They're buying non-performing loans and they're taking properties back that way. But mainly it's the on-market channel, i.e. the MLS, and then off-market channels wherever they can find them. And that's the big opportunity that we see. That's why we're doing what we're doing, is that houses that have tenants in them don't belong in the MLS. Literally, if you had you can try this. You call up a real estate company and say, hey, I have 25 houses I want to sell. They say, goody. Then you say they have tenants in them, and they say, oh, we don't know. You have to wait till those are vacant. Mm-hmm. And so you want to sell something in a package. It's stabilized, and the advice you get is destabilize it. It doesn't fit. So there's actually a very substantial, very inefficient market of off-market, off-the-grid, occupied rental properties that we're just starting to organize that now. So it's still very early.
Charles, of course, then the question becomes, what does the financing landscape look like? What are the options available?
It's interesting because what got the most amount of press was Freddie getting into the market and Freddie getting out of the market and Fannie doing the Invitation Homes deal. What I tell everybody is that I didn't look at that as bad news, because what it did was it was a market that was under the radar. It was a market that is a good market that didn't necessarily have what we would call legitimacy, that they felt, just as we talked about, that there was a lot of mom and pops running around operating 10 to 50 units, and it wasn't necessarily an institutional approach. The funny thing is, in this market, institutional is 10 units or more. So there's always been institutional investors. They've just been on a smaller scale, but there really hasn't been a national product, nor has there been a product that everyone felt that they could get. A lot of people went to their local financial institutions and say they acquired 20 units. They might have 20 separate mortgages. Now, what we can do and what we can offer is what I call consolidation or a blanket mortgage, where you can come to me with those 25 units, with those 50 units. You might currently have finance with your local financial institution, and you're managing. I have to pay one on the 5th of the month, one on the 4th, and my administrative costs are probably more than they should be. and I'm just going to come and do one loan. The availability of the Freddie product was great, but right now, we as Arbor, we have other lending partners. We have other opportunities that we are lending. Freddie was restricted with respect to the fact of you can go under $5 million. There was an affordability percentage of the units that had to be there. Now we can go with our other lenders down to $2 million. There is no restriction on affordability, and the capital is available. The other piece is, and this is going to be more of a case-by-case basis, is that a bridge lending perspective. Arbor can provide bridge money, something right now that we're willing to balance sheet, and of course we're going to look for what our exit is, and we're going to be speaking with our lending partners as it relates to, okay, fine, here's the deal, here's what we have, we're going to bridge it. Nothing's unequivocal, but if we have good color on an exit on a deal, then we're more than willing to talk about bridge financing. It could be somebody has to close fast, somebody who's not ready for what I call an institutional lending, meaning that they want to put some rehab in, they want to lease up some units, or they might want to increase the rent.
Right. So folks that are listening in, we're going to go to Q&A in just a couple of minutes. Before we do that, can you walk us, Charles, through the single-family rental scenario?
With respect to underwriting, again, it's we have a rental scenario where there's a borrower who's challenged, borrower looking to acquire a large portfolio, they require improvements, he needs short-term money, 24 to 48. And again, a lot of institutions may not be willing to stand by you in this market because they don't understand it, provide that bridge. We do have a balance sheet to be able to do this. We do have a balance sheet to where we can say, okay, you need to close quick. I understand what you want to do because similarities between small balance space, similarities between multifamily and a value add. And again, it's all about opportunities, but it's also for us to facilitate that and diversify our own lending base.
So the first question that's coming in here, someone's asking, one of the listeners is asking, if I'm approaching Arbor, for financing, how does the underwriting process for SFR differ from small balance multifamily? Is there other information you need from me that makes it materially different?
No, I mean, you're still going to be looking for historical income and expense information. If it's an acquisition, well, how did you do your due diligence if you don't have any of that information? Again, what's your experience, not only in this market, but with this product? What's going to be slightly different is I personally don't think the engineering as is intensive, the getting an engineering report, because it's more of a, what I'll call a walkthrough. The environmental are really just a Sanborn maps and what has historically been done in the area, and the appraisals are not as intensive. They're more of what I call homeowners or single family, unless, again, we talked about before, if you're looking from an income approach perspective or that what we're calling the hybrid approach as an investment property. That, again, is going to be more traditional, going to be more with the inspections, going to be more relying on the appraiser to get comps and to cap out the numbers.
So as an institutional market, I think we've heard from Greg, this is a very, very new space. What do you look for in terms of the kind of track record that a borrower might have in single-family rentals, given that it is new?
They may not have in single-family rentals, but they may have owned and operated properties. They might have roots in a network. I'm also going to look at where they're getting their funding from, how are they putting it together, what kind of skin that they might have in the game, and how vested they are in that product. Again, we always talk about is, playing in your own backyard. Someone who's a large institution who's buying in different places is going to get a little more leeway versus somebody who, whether it be if Greg Rand came up to me and said to me, something, Charles, I think this single-family stuff is a good idea. I've never done it before. I'm putting no money down, and I've gotten investments from, all these different people that I've gone on a website and created.
Yeah, we got a really interesting question from one of our listeners. Someone works with you, gets a portfolio loan. There's a pool of properties there. One of them happens to be in a neighborhood where appreciation is really moving in the right direction. What can you do in terms of partial releases? Can I take that single home out and actually sell it?
There are within this single-family rental, you have to have releases in any of your deals. That is the market. That's what happens. It's typically percentage-wise, you're probably 10 to 15% of whether it's dollar amount or units within the property, but there are release provisions that are provided within the loan documents.
Yeah. Greg, a question for you. Many of our listeners have tremendous experience in operating multifamily assets. From an operational perspective, are there economies of scale in single-family rental? What does the operational side of this look like?
Yeah, well, the two big things I've already touched on. One of them is that it is more complicated to manage physically because they're scattered, but the tenants stay longer, and so the revenue is easier to manage. They tend to set roots down. They tend to, the kids play with kids on the cul-de-sac. It's a different kind of a longevity for the tenant. But you just said something key a moment ago, that the granular nature of single family. Now, you can't decide that nobody wants one-bedroom apartments anymore, so we're going to sell our one-bedrooms. You can't do that in multifamily. You can decide that everything on the west side of the highway we're going to sell, either because the prices are up and it's opportunistic, or because we regret having bought it in the first place. You can go down to one door. And that goes back to this, and that's why I'm happy to hear about the releases, is that is part of the market. They do see that as one of the owner-operators of SFR portfolios that are going to win long-term are the ones that learn how to play those different dials and how to adjust based upon market conditions and different things right down to the individual door level and dynamically pull in and out of their portfolio. And that, I think, is what we've only begun to see, the benefits of that kind of granularity and that duality of a property's use. And so that, I think that's going to wind up being the thing that the big winners are going to be judged based on how well they play that game.
Yeah. So we're nearly out of time. I'm going to squeeze one more listener question in here. Greg, if you could to recap this for us, where are institutions most active around the country, and where do you see some of the opportunity?
I already mentioned the active places, okay? The places where people are asking us now who are coming into the space new, where should I go? Where everybody else isn't, okay? And what we've learned over the years is that if you track price appreciation and yield in SFR, they usually, when you combine them, end up being around a 9, okay? So some cities are, like in Dallas, is going to be a 5.5 and a 3.5, 5.5% yield, 3.5 appreciation. You can tap into some of the same fundamentals of Dallas. In Oklahoma City, you get a higher yield, bit of a lower price appreciation curve, but same basic fundamentals, same industries that are driving it, and yet it's not been trampled on by a lot of other big players. If you go in and buy 500 houses, you're the biggest landlord in town.
You're not tied to one neighborhood within that city.
Correct.
Suzanne, I'm going to pass it back to you.
Well, thank you again, Sam, for this very interesting discussion, and thanks to our speakers. We are out of time today. If we weren't able to address your question, we will follow up separately, and we'll be sending you a link to the recording so you can review the information you heard today at your leisure. Thanks again to our speakers, and thank you to our attendees.
Thank you.
Thank you.
Thank you.